It's Friday, 24th of January, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, a US energy crisis demands for Saudi Arabia to open the taps. What next for oil? But first, Neil Shearing joins me fresh from the trenches of a week in macro and markets. Hi there, Neil. How's it going?
Hi, David. All well. How are you?
Yeah, good. I read a story in the paper that said that Donald Trump was made president again. What on earth makes that?
Yeah, indeed. Yeah, it's going to keep us busy, I think, is my hot take. I think it's going to be a busy 4 years.
Yeah, we seem to be back in that cycle, don't we? Where the narrative in the markets in the morning, frankly, doesn't survive the afternoon because of some off-the-cuff comment that's made to a reporter. It's telling his inaugural address, there was, he didn't mention tariffs and everyone went, yippee. And then he spoke afterwards off script and he did mention them. And then everyone went, oh, boo. And then it was Canada and Mexico and China. And then it was the EU. And you kind of get to this point where it's not clear really where we are in terms of tariffs and whether this is just about pressuring trading partners to get a deal or whether he sees tariffs as an end, in and of themselves. So we're near the end of the first week of his second term. Where do we stand on this tariff question?
Well, short of having a broad sense that tariffs are coming down the track, I don't think anyone knows. I think that's the key takeaway from this week. And I don't think, if we're being honest, that the administration knows either. We've had mixed messages in terms of the focus of tariffs. So like you say, Canada and Mexico appear to be in the immediate firing line. But then later this week, President Trump's made reference to China and also to the European Union, treating the US very badly, and they'll have to pay. So there's different countries in the firing line. I think that the key uncertainty is not just around kind of countries and the level of tariffs, but also the purpose. I think this is perhaps the most important part. Is this a tool just to extract some concessions from the European Union, for example, on defense spending, or China and Mexico on changes to the USMCA agreement that may, for example, benefit US car producers? Or is it a means of raising new permanent sources of revenue for the US government that would help to finance the extension of the 2017-2018 tax cuts that are due to expire this year and potentially pay for additional tax cuts too? That's the key part that's still missing, I think, and that we don't have much certainty over. And I think, frankly, that's because the administration hasn't quite worked out what the plan and strategy is here.
But it could be a bit of both, couldn't it? Where you have tariffs in place to try to extract concessions from trading partners, but at the same time, you have a president who sees tariffs as a fundamental toolkit of raising revenues. And, he talks about things like the ERS, the External Revenue Service, and he harks back to a time in US history where tariffs were just part of the permanent policy toolkit. So do you think that's where we could wind up in, where we have both sorts of scenarios?
Well, possibly, but it feels to me that that's a bit internally inconsistent insofar as if you're imposing tariffs to extract a concession, then if you're successful in extracting that concession, then by definition, the tariff should be lifted. That it served its purpose and the foreign government gives you what you want. So at that point, you lift the tariff. That is not, therefore, a permanent source of revenue. So there are, of course, shades of grey here. It's possible that we get some tariffs go up on a permanent basis and that's a permanent source of revenue, and others that are imposed and then rolled back as the US government extracts concessions. Of course, that's possible. But the numbers we would be dealing with in terms of the revenue raised in that scenario would be pretty small, pretty modest. So if it's going to be a major source of permanent revenue, then it can't at the same time be used as a tool to extract concessions, at least as I see things.
Either way, it's an uneasy backdrop for the first big central bank decisions of 2025, isn't it? We've had the BOJ this morning, another hike, but nowhere near the violent market reaction we had last summer. Now we've got the ECB and the Fed coming up, yet we've still got this uncertainty around tariffs that you talk about. You've got a feel for central bankers, don't you? But particularly, I want to talk about the Fed because Trump has made no bones about how he feels about Powell. And then his latest comments are that he knows more about interest rates than anyone in the Fed does, and that he wants those rates to be lower. it's got to be a pretty awkward environment for the FOMC going into a meeting where we're expecting them to hold, right?
Yes, so our forecast is that they'll pause at the upcoming meeting, and there are three factors going into that decision. The first is, frankly, the US economy is doing okay. Our GDP tracker is tracking at 2.9% Q-on-Q annualized for Q1, so pretty robust growth. It looks like the handover from Q4 into Q1 at the back end of last year, some of the data we're getting out has been pretty strong. So the economy itself is holding up and performing pretty well. Then you've got, as you say, the pressure on the Fed from the Trump administration to cut interest rates. You've got to weigh that too. And the third issue is that just the policy uncertainty. We've talked a bit about tariffs, haven't we? You know, the extent to which they might be raised. Obviously, that will have an impact on inflation, albeit a short-lived one. But there are other areas of policy that are still extremely uncertain too. Immigration reform and what that might do to the labour supply in the US, and of course fiscal policy, the extent to which major additional tax cuts may or may not be passed. We of course have been a bit sceptical on the idea that there will be significant additional deficit finance tax cuts, but it's a factor that you've got to take into consideration if you're setting interest rates. So there are several reasons, I think, against that backdrop to think that the Fed will pause. We've got 2 more 25 basis point cuts to US rates in our forecast, but frankly, I think it wouldn't take much for us to take one or even both of those out of our forecast, given the strength of some of the data and potentially the changes in policy coming down the track.
I mean, if that's the outlook, then we've got to be looking at a pretty contentious relationship between the White House and the Fed over the next, I think it's about 18 months that Powell steps down. Is it May next year? We spoke before about Nixon's relationship with Arthur Burns, who was the Fed chair during his time. That was pretty pliable as far as these relationships go. But actually, the New York Times had a really good rundown of what happened with LBJ and William McChesney Martin in the 60s, where LBJ winds up shoving Martin up against a wall at his ranch in Texas after the Fed raises rates again. How is that relationship between the Fed and the presidency going to pan out? Is there any influence here that Trump can have on Powell?
Yeah, you've just conjured up the image of, I don't know what the modern day image is. Maybe it's Trump shoving Powell up against the wall in Trump Tower. I don't know. I think that the ability of the president to influence the decisions made by the FOMC is, I think, more limited these days. And of course, Powell's on the record as saying that the president will have no influence over the setting of interest rates. Now, over policy towards the financial sector more generally, the financial regulation, yes, there's clearly ways that the administration can influence the Fed in that regard. But I think as it relates to monetary policy and the setting of interest rates, the influence of the president is going to be more limited. So we'll get noises off, I'm sure, about the need to cut interest rates. We've had it again this week, as you say, and talking at Davos over video conference. So we'll get noises off from the sidelines, I'm sure, about the need to cut interest rates and pressure on the Fed. That could make for a bumpy path in markets, but I don't think it will necessarily have a major bearing on Fed policy.
What about other central banks who are trying to calibrate policy in this environment? I'm not suggesting that Trump is ever going to shove Christine Lagarde or Andrew Bailey up against a wall. But there's this appetite for lower rates, but at the same time, there's uncertainty on the inflation front. And as you say, there's uncertainty globally in terms of US trade policy. So how do you think these banks are going to navigate these waters?
Yes, I think that's right. I think central banks globally are in a rather difficult position because it's not just the impact, the effect of US policy with respect to trade or migration or even fiscal policy that can have an influence on the rest of the world. The US, of course, being the world's largest economy and the issuer of the world's reserve currency. That, by definition, policy there has an effect on the rest of the world. But also, it's the response to those policies of governments elsewhere in the world. So it's possible that Trump levies tariffs on the European Union and EU governments respond by levying tariffs on imports from the US. And all of that would have an impact on the Eurozone economy. Now, our judgment is that those effects would be relatively small, relatively modest. I don't think that would have necessarily a major bearing on setting a monetary policy in the Eurozone or indeed the UK, but that's not true necessarily of Canada or Mexico, where if 25% tariffs really are levied on imports from those countries to the US, then that would have a significant bearing on those economies and something that central banks in both countries would have to take into account. Now, in the coming week, we have the ECB meeting. We are expecting 25 basis point cut in rates. That's pretty much priced into markets there. But I think when you cast your eye further out and you look at the kind of persistent weakness of the data, pointing to continued stagnation in the Eurozone economy. If you look at the data suggesting that the labour market conditions are starting to loosen, then I think there's still a good reason, despite all the uncertainty around US policy, the potential threat of tariffs, and the fact that the Fed, may be on pause at this meeting and possibly could be done in this loosening cycle, although it's not in our forecast now. I still think there's a good reason to think that the ECB will cut interest rates by perhaps a bit more than the market is expecting, given the weakness of the European economy. Meanwhile, we've got the Bank of Canada. We're forecasting 25 basis point cut there too. And like I say, there could be more aggressive cuts there if Trump really does follow through with a 25% tariff on imports from Canada. So a different impact of potential changes in US policy on different central banks. In Europe, I don't think it will have a major bearing. And like I say, I think interest rates will be cut a bit further than markets are anticipating. In Canada, it could have a more substantial impact depending on what policies we get. But like I say, I don't think anyone really knows on that front at this stage.
I wanted to end on Stargate. So until this week, it was the name of a not very good 90s sci-fi movie. Now it's a $500 billion AI infrastructure investment vehicle. Lots of news about it. Markets obviously taking it very well. Another bout of enthusiasm around AI firms driving the S&P to new highs. But taking a step back, what I think is interesting here is that for all this talk about Trump's ability perhaps to get a deal done with China to settle trade disputes, there's this idea of a Mar-a-Lago Accord, or maybe, Trump and Xi shaking hands in the Great Hall of the People in Beijing. The fact is, this press release, to me, it does speak, doesn't it, of this ongoing war between the US and China at the commanding heights of the global economy. And it drives home the fact that regardless of the ability to get some sort of near-term deal done, that we're still in a fracturing world, aren't we?
I think that's a really good point. And I agree that's something that comes through in this announcement. So obviously, this is a private initiative. This is not something that has federal government money behind it. But obviously, it's been greeted by enthusiasm by the incoming administration. And I think you're right. It does underscore the extent to which there is going to be growing geopolitical competition over key areas at what we might call the technological frontier, AI being a core part of that. And there's a clear push here to get infrastructure around AI built and hosted in the US, and to curb reliance particularly on China. Obviously, it's not just AI where this is happening. It's happening in associated areas like semiconductors as well. So yes, the policy will ebb and flow, and there'll be lots of noises in the background. And I suspect it's possible that some kind of deal is done with China. Trump, of course, likes to present himself as a deal maker. I'm sure, and an opportunity to kind of shake hands in a grand ceremony, I'm sure is a possibility. But would it alter the kind of fundamental dynamic between the US and China, this deepening geopolitical rivalry? No, I don't think it will. And I think the Stargate project is just one manifestation of that.
Neil Shearing on global fracturing, tariff uncertainty, and central banking in the second Trump administration. We'll have more to say about central banking under Trump on a drop-in. That's one of our short-form online briefings this coming Thursday. That's 10 a.m. Eastern, 3 p.m. London, in which the team are going to be reviewing the Fed and ECB's January meeting and previewing the Bank of England meeting on February the 6th. I'm also going to link in the podcast notes to our central bank hub, because that's the primary resource for all of our forecasts on how DM and EM central banks are going to be adjusting policy over the coming 2 years. And it also links off to relevant bits of analysis, so do take time to explore that. We're just a few days into the Trump presidency, and there is already a load of great new analysis on what this all means, building on the work that we did during the campaign and during the transition. One report to note is a new piece of analysis that was out today, so Friday, on what a strong dollar means for the global economy. Short term, not such a problem. Longer term, a very different story. Simon McAdam, our Deputy Chief Global Economist and the report's author, will hopefully be doing a drop-in all about this in the coming days. days. Look out for details of all of our drop-ins on our events page, capitaleconomics.com/events. Now, Trump's return has meant a very busy week for oil markets. The new president, in short order, has declared drill baby drill. He's declared a national energy emergency, and he's called on Saudi Arabia to lower prices. There's almost too much news, so to make sense of all of it, David Oxley, our Chief Commodities and Climate Economist, got his team of Kieran Tompkins, Olivia and Hamad Hussain online to tackle the main questions around oil prices and where they're going, and here's that chat now.
It's been a week into Donald Trump's second term as president, and we've already seen lots of things of relevance for global energy and particularly oil markets, particularly against the backdrop of his speech at Davos yesterday. Kieran, this protestation for Trump saying he was going to ask Saudi and OPEC to lower oil prices, what are the chances that Saudi will listen to Trump and do what he wants?
Well, I guess on the face of it, they're not guaranteed to listen to him. Our fracturing work that has showed that Saudi Arabia drifted away from the US's sphere of influence over recent years. And it's also a very big ask for them to lower the prices of a key export for them. But that being said, we also think there's some nuance at play here. Relations between Saudi and the US have been warming a little bit more recently. And it's been known that Trump has very good relations with Crown Prince MBS, both in his first term as president and also through his business ties in the meantime. And another thing that had already been at play in the market is that we had been suspecting that the chances of Saudi flooding the market had grown over recent months. And that's come amid frustration by Saudi Arabia and officials over production among selected OPEC Plus members. And so we think there's a decent chance that they might change tack on oil policy as a way to punish these cheating members and also as a way to claw back market share that they've lost over the past couple of years. So this invitation from Trump might be the cover that Saudi Arabia needs.
Yeah, and just for context, I mean, you'd already estimated the chance of Saudi opening the floodgates around about 25-30% this year, and that was before this protestation. And just for context, we've warned that you're not talking about a $5 or $10 drop in oil prices on the back of this potential scenario where you could potentially envisage, depending on how quickly and how extensively Saudi did open the floodgates. I mean, oil prices getting back to $30, $40 per barrel is certainly not out of the question. Olivia, turn to you. I mean, obviously, there is a big inconsistency here between Donald Trump's push for lower oil prices and also his desire to see oil production rise in the US. Just how low is too low for US oil producers in terms of trying to increase output, as Donald Trump would clearly like to see?
Yeah, no, that's a great question, because obviously, whatever Trump's aims are for energy policy, at the end of the day, the entities that are going to be making the decision to drill more are private companies. And so their incentive to drill what the oil price is, it really matters. So, estimates, they differ from region to region, but current estimates would probably put break-even prices at around $60 to $70 in most key producing regions in the US. And with WTI about $75 currently on Friday morning UK time, prices don't really have much further to fall before there is little incentive to raise drilling activity, really. And when it comes to higher cost regions like Alaska, where break-even estimates are more like $75 for drilling new wells, aims to develop resources in the region seem quite unlikely. Obviously, in recent years, we've seen technological breakthroughs have meant that oil production continue to rise, even though new drilling activity has been quite soft. But in the absence of further breakthroughs and jumps in productivity, that aim of raising oil output will be, quite challenging to meet.
Great. And just turning to you, Hamad, the other question, well, we've got a lot this week. Will Donald Trump get his way of lowering gasoline prices? I mean, that's obviously clearly a big part of what he's got his eye on. What do you think is going to happen there?
Yeah, that's a really good question, because there's a lot of moving parts here at play. Of course, if Trump is able to get OPEC to use more of its 6 million barrels per day of spare capacity, then of course that would send oil prices and gasoline prices way lower. But on the other hand, of course, that would squeeze US oil production, and some producers may resist increase in output. Meanwhile, Trump's plans for tariffs on Canada and Mexico which account for more than half of US oil imports, would probably hurt the margins of US oil refineries, and in turn that may put some upward pressure on gasoline prices. So all in all, it's a very mixed picture at the minute.
And our forecast, we do forecast oil prices to fall. We were forecasting oil prices to fall before Donald Trump got in, primarily because of a weak demand backdrop and the potential for OPEC to add more to supply. But the downside risks to oil prices have risen on the back of this news this week.
Our Commodities and Climate team in action. You just heard David Oxley talking to Kieran Tompkins, Olivia Cross and Hamad Hussain in that order. We're only a few days into this administration and they've scrambled to tackle the various issues around energy that Trump has already raised. Possibly their key point on oil is that Saudi has an awful lot of spare capacity, and if it decides to move on that, in the past few days has certainly raised that possibility of that happening, then oil prices falling to the $30 to $40 range wouldn't be out of the question. I'm going to add Kieran's note on this from last October to the show notes, along with the team's report this week on whether this really is an energy emergency for the US. But that's it for this week. We are back next week with more on this new era in global macro and markets, including a special look at what's been happening to China's global export market share. We've got a new report out all about this, and it is a total eye-opener. In the meantime, if you're celebrating, then a happy, healthy, and prosperous year of the snake. And until next time, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.